As a multifamily broker, I broker the sale of deals that are from 10 to 99 units and anything that's 100 units or more. There's been a recent trend in the last year or so where 100 plus unit investors are picking up under 100 unit deals. There's good reasons why. Stick around. Let's go! I was on Jerome Meyer's podcast recently called Multifamily Missteps, and we talked about this phenomenon of investors picking up these under 100 unit deals. The lack of 100 plus unit deals coming available for sale has forced some investors to consider alternative size deals in order to supplement and place their equity. All right, let's jump right in. Take a listen.
So when you talk about data and you look at the market today, how are you advising buyers? Because some of this stuff just seems completely out of whack to me, but I may just be too conservative.
The problem is that we've all been saying things are out of whack since 2014. The question is will we be saying the same thing in 2026? In 2026, will you be wishing that you had bought a lot of things in 2021 and 2022? I don't see things going in reverse or slowing down in the multifamily field. House prices may slow down a little bit coming up. Office conditions can always change. The retail sector can change. But industrial and multifamily, we are so far behind in what we need to deliver to meet the demand. I don't know that we ever will. Under 100 units, people are paying a little more than what the rent is increasing, but that's only because under 100 unit deals for so long have not gotten their dues. They have traded at a gross rent multiple or a cap rate or whatever metric you want to go by, lower than 100 plus units by a large margin for a very long time. And I get why it is, because big players want to place a lot of capital at one time and they're willing to pay more for that right. And they have amenities and so forth. But smaller properties run on lower operating expense ratios, but they've traded, let's just use gross rent multiples because I never trust cap rates. Gross rent multiples, when looked at in the macro sense, not pricing any one property, can really tell a good story. So gross rent multiples for under 100 unit deals have typically traded around 8.1, and 100 plus unit deals are trading at about 9.4, 9.5. Now those eights in the under 100 unit sector are now crossing into the nines, partly because people are noticing, hey, yes, these are good, profitable assets. You just have to buy more of them in order to place your capital. But secondly, there's just such a lack of opportunities in 100 plus units. Some of the big boys who are able to be a chameleon are buying 60, 70, 80 unit deals.
And it's funny because most people say, I don't want that. That's a tweener. I can't do anything with it. It's too small to put somebody on site and it's too big for third-party offsite to handle it.
I think it's a big mistake for those who have the ability to buy tweeners. I get it if you are a 5,000 unit syndication, time is money. You only have so many of the manpower resources, and it takes the same amount of time to do a 30 unit deal as it does a 200 unit deal. It's tough to really concentrate on anything smaller. However, for those that are small to medium-sized syndications, mom and pops, wealthy individuals or partnerships or whatever it is, I know several players who I've done a ton of deals with that listen to my advice early on, which is that all these deals that you may pass up over the next 5 years, when I bring you 20, 40, 80 unit deals several times a year over a 5-year period, after 5 years, if you had bought 6 more 50 unit deals that you normally wouldn't have bought, you will be 300 units ahead of someone else who only concentrate on those. And by the way, especially if you're concentrating in certain markets, if you've got 5 or 6, 20, 30, 60 unit assets in one market, you've got a hell of a management engine now. So when you do pick up the 100, 200 unit deal, you're already ahead of someone else, because you got those efficiencies in place. So there are players who have the ability to knock down 200, 300 unit deals all day long, and they do, that have modified their model to pick up some smaller assets and learn how to manage them efficiently.
You're saying that people are missing out on the smaller assets and opportunity to grow their portfolio profitably by saying they're only going to do 100 unit plus deals.
Absolutely.
In emerging markets.
Because you ain't managing them. I mean, someone else is managing for you. It's not like the principal is going to be on site managing the asset, right? They're going to be managed by a third-party company. All you're going to do is collect a check. It's the time to do a deal and the resources. That's why they get passed up on. It still takes 60 days of effort of doing a phase one, doing the PSAs, the inspections, negotiating the debt. All those things take human resources, but it's a finite amount of time. If you don't have anything else going on, if you don't have 3 other 200 unit deals going on, you might as well knock one out. Because in 10 years, if you held it and you threw everything at it and you paid it off in 10 years, is it nice to have a 50 unit free and clear deal bringing in that kind of cash? I think so. And again, I'm talking about that segment that has the ability to do that, not the guys who are already so big that it actually would cost them money to provide the resources to pick up smaller assets.
You're challenging the vast majority of the folks who are in syndication school right now.
They should.
And I think you should. I think there's a tremendous amount of opportunity in a space that you're talking about, and even smaller, depending on where you are on your journey. I agree with you. The profitability comment that you made, I'd like to go deeper on that because I don't think many people get that there is space there.
Particularly like once you don't have on-site staff, right? So once you're able to remove labor, which is running $1,300 a unit per year for labor alone, once you remove that, so that's like under 50, 60 units, those typically run between $3,500 and $4,500 a unit in total expenses per year. Whereas the average for anything 100, 150 plus units is about $5,500 to $6,000 per year. The expenses are less, and sometimes the rents can be as high as larger complexes depending on the location. Now, they're not on average. The average, I think, 100 plus unit deal right now is like $960 a month or something like that. And it's like $730 or $740 for an under 100 unit deal. But if you can pick up nice assets in nice areas that are smaller, they have lower expenses per unit per year. Those are nice little gems to pick up. Hey, I get it. Buying 100 plus unit deals makes a lot of sense. It's what I prefer to broker, but I'm also understanding the benefit of having smaller assets as part of the portfolio. I hope this video brought you some value, and if it did, please give me a like down below. Make sure you subscribe and hit that notification bell right next to it so that you're made aware of each video that comes available. See you guys on the next one.